This is Satya Pradyuman of Cirrus Research. I want to call your attention to our latest quarterly outlook, the Cirrus Dispatch. The title, When Investors Chase the Pick and Shovels of the AI Trade. And at the heart of this is this very topsy-turvy market we've lived in the first half of this year, which is the dominance of 6 to 7 technology names, whereas the rest of the market, notably the broader market, has just been left behind. And as we see these equity multiples climb to new and higher prices, the question is, how much does it last? So the point of this report delves into this sort of single pocket risk that may be really opening or reopening to greater and greater heights. This curve represents about 30 years of comparisons in the technology sector. We're looking at large tech stocks, their multiples against their small tech counterparts. We're looking basically here at a 30-year differential between how these two groups have traded. The theory is that if technology spending is accelerating, then what we should end up seeing is the multiples for both of these groups really continue to rise in somewhat of an aligned fashion. At some periods better for one group, another. But to this point, it's quite extreme. And it raises some questions about how the durability of this ongoing trade. Importantly, what we're also looking at is the demand for technology spending and consumption. And at the heart of it is that this curve relates not only the multiples of the tech sector, but also how demand is slowing. So this becomes the fundamental risk really to the trade. Some of it is valuation, some of it is ultimately demand. Technically, we are likely to see this race continue if interest rates remain really benign, crowding remains benign, and also risk appetites remain benign. Some of those are still in place, but we think those are starting to change. The other part of this report is really focused on what else is going on in the investing side and that what sectors could benefit. And what we are also showing is that the slowdown or the peaking of technology spending is counter to the spending that we're witnessing in the industrial sector. We do believe, for a number of reasons, that there is an industrial infrastructure spend underway. This is likely to be a multi-year event, and as a result, a fairly sizable rotation hitting the equity markets. So we think that this area of industrial spending is likely, as it moves up, it potentially moves at the risk of technology spending accelerating. And so from a year to date in the last year or two, we've seen the industrial spend stabilize and begin to recover. If this continues, we'll see really a major blow to leadership in the current market. Finally, in terms of the portfolio views, given the fact that the profit cycle continues to slow, we remain on a quality bent. We do think that this trending market that's underway, unless we were to see 2-3 of the critical indicators that we're tracking that all turn red, the trending components and therefore the aggressive growth model should also continue to work. Again, the fundamentals don't line up, but markets don't always trade on fundamentals. With any questions, feel free to give us a call. Thank you.